expenses assigned to this product would be reallocated to other product line. Okay. So it's just, if we drop this product, so those fixed expenses going to be added to other segments. So the equipment used to manufacture digital watch has no resale value. So the plant that making this digital watch, if you resell it, it has zero salvage value. So should Lowell retain or drop the digital watch? Let's just talk about that. So lost contribution margin will be our loss, right? Lost income would be our expense. So that's why we just keep it as $300,000 lost. So what happened? And then you decrease all the relevant costs. So if you avoid salary, that would be your benefit, right? 90,000, you will fire the line manager, you will avoid advertising, you will avoid rent space. So you see here, you would be saving 260,000 in cost, with the contribution margin profit lost is going to be 300,000. Look at that. So if you drop this one, total company overall profitability will decrease by 40,000. If you keep it, your loss is 100,000, right? But if you drop it, your total loss is going to be 140,000. So what's your suggestion? It's better to have less loss. 100,000 is okay. We agree. If we drop it, we have to pay more $40,000. We have to, the loss is going to be increased. Right? David, Sipade, Chandra, Christine, understand?
Yes.
Yes, sir.
So when you make decision based on retaining the product or dropping the product, see the profitability. So lost income is going to be is shown in negative sign, and the cost is going to be your benefit because you can avoid it, so you can write in positive term, right? And the net effect, you can see that. So the Lowell situation can also be obtained by preparing comparative statement. So if you can make a comparative statement, you can say as well, okay. So if you keep the digital watch or drop it, so if you drop it, you will lost the contribution margin, or you will lost sales, no sales, you still have differential. So this is differential analysis. Here we go, here we go, here we go, here we go. So you will 300,000. So less fixed expenses, you still have to pay the general factory expenses. So it's the same in both alternatives. So we are not writing it in our differential analysis. Salary of line manager, you can avoid it. So it's a 0 here. So differential is, see, scenario 1 minus 2. So you can just write it down like this. Depreciation is now, you can say that it's irrelevant, so just avoid it. Don't write it here, or you can say that it's common here. Advertising, you can save it. Similarly, space, you can save it, but you cannot save the general expenses. You cannot save the general factory overhead. So the analysis is the same. Right? So instead of incurring 100,000 loss, you are incurring 140,000 loss. So that's why retain it. So the question that we just answered, then why should we keep digital watch if it's showing us 100,000 loss? The managers can discuss the answer as the answer lies in the allocation of common fixed cost. So some of the cost that this segment is using If we drop that one, so they must be allocated or they would be spread to all other segments as well. So that's why we are retaining it. So our allocation can make a segment less profitable than it really is, right? So actually it is saving our loss 40,000 rather than if we drop it, we will be incurring $140,000 worth of loss. So retaining it, decreasing our loss. If you understand all this discussion, so we have a question here. So it looks scary, but it's not. It's a very simple question. So only just reading this, all this, it takes time. So I'm going to be again setting up the breakout room. All you need to do, just read the question and answer this requirement here. Oh, sorry. Answer this requirement here. So what will happen if you keep it or retain it? Okay, so you have 3 products: dirt bikes, mountain bikes, racing bikes. We have total information here. So you will see that and you will find out that, okay, should we keep it or should we drop it? So take a picture. Meanwhile, I set up the breakout room. Okay, please join our breakout room. David, please join our breakout room. Good. Okay, so I'm going to resume the pause the recording. After breakout room, I will be resuming the recording. Okay, guys, so we have done our breakout room activity. So let's discuss the answer. So Christine, what is your analysis? Keep it or drop it?
Yeah, I think they should keep it.
So Chandra, what is your analysis?
Yeah, same as Christian.
Sipaday?
Same.
So how did you solve it? So on what basis? Christine? Okay. David, you finished?
I mean, I did something, but I'm not sure whether it's correct or wrong.
Okay, then let's just see the answer. So here, so if we drop it, so we would be losing income 27, right? So you say minus 27. Let's see the answer, right? So you will save the cost advertising and salary of the product line manager. So you are losing 27,000 and saving 16,000. So here you see that we talked about that depreciation is not included. Let me just erase all this mess. So depreciation is sunk cost or not relevant. So depreciation, we do not include that one. Plus the allocated common fixed cost. You see the star here, and they say allocated on the basis of sales dollar. So it means if we drop the racing bike, it will be distributed on dirt bike and mountain bike. So we cannot avoid this one. So this is unavoidable, right? Understand? Christine, Sipade, Chandra?
Yes.
So,
Yeah.
so these two
Yes.
basis on depreciation and common fixed cost. So our analysis is changed. If we drop it, our loss gonna be 11,000, and if we keep it, our analysis is 9,000. So it's better to keep it. Now the relevant decision can also be used in make or buy analysis, right? So the same, all the fundamental rules are the same. We see the relevant cost. If it's give you more profit to make it, then please make it. And if it's increasing your loss, then buy from the outside. So when companies involved from more than one activity in the entire value chain, like you are making the product, so you are making different parts. So a decision to carry out one of the activities in its value chain internally rather than to buy externally for supplier, we call this decision make or buy decision. Or you can say that you outsource some of the parts to someone else to make for you, or you make by yourself. So the scene is the same. So we have an example, which is a sex company manufactures part 4A that is used in one of its products. So part 4A, and the unit price is like this. So we have direct material, direct labor, variable overhead, depreciation, supervisor salary, general factory overhead. So it cost us 30 per unit. So one supplier. So additional information is it has no resale value. The equipment that make for a product, no resale value. So total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by the decision, which means if you drop it, you still would be, paying for this cost, general factory overhead. Okay, the $30 unit cost is based on 20,000 parts produced each other. It means they are producing 20,000 parts each other. So the outsider supplier, he quoted you that, okay, I'm going to give you these 20,000 parts at $25 each. So it costs you $30 and he's giving you at $25. So if you are a layman, you will say that, okay, you just provide me at $25. So if you are a cost accountant, you know the managerial accounting stuff, then you will do some analysis. So we know that the general factory overhead is not going to be effective. So this is, we need to talk about that. Okay. So you are, 20,000 parts multiply by 25. Answer would be 500,000. So make and buy decision, right? Make or buy decision. So just see here. So if you are making that one, so 20,000 parts, so see direct material 9 multiply by 20,000. Answer would be 180,000. Direct labor 5 each multiply by 20,000. Answer would be 100,000. Variable cost 1 each, so 20,000. Depreciation is not relevant, so you drop it. Supervisor salary 2 per unit, so 20,000. Answer would be 40,000. General factory overhead is the same in both, so we avoid it. So you see, if you make it, it costs you $340,000. If you buy it, it costs you $500,000. So avoidable cost with making for A, part 4A includes direct material,